Patient is a wonderful word. It can mean a lot of things. You know, there's patient in the sense that you're patient waiting for your subway. There's patient in the sense that a parent is patient with their toddler, which is extreme patient. And so there's an entire range of things that could mean. I think we're kind of in subway patient at the moment where there's been a tail risk that's priced into markets. The risk that this sharp and abrupt deceleration in the US economy keeps going past trend. And so that tail risk has influenced Fed rhetoric and potentially Fed policy in the future. But if we're correct that this is actually a no recession outcome this year, the pricing of that tail risk recedes, and I think the Fed does get in a couple hikes this year.
So Noah, given that backdrop, what do? We've seen a 10% or so recovery in the S&P since that Christmas Eve meltdown. Would you still be a buyer?
So yeah, I would still be a buyer here. I think the challenge, of course, is that the market may be over anticipating, like you said, patience, like in the toddler context. I don't think that's the right attitude to have. That said, we think the market way overdid the nervousness relative to where we see the economic backdrop and relative to where we see some fundamentals. The tricky thing here is that I don't think this is the time for a high beta cyclical rally. You're asking the market to rally in the context of what's a slowing economy, which is what we've been expecting. But yet you overpriced it a little bit too much to the downside. So we would still be a buyer here, but cautiously so because the environment isn't great.
How are you feeling today, Krishna?
Well,
are you a buyer?
From our perspective, the conclusion is relatively straightforward. In the current environment where policy in 2019 is going to be far more supportive than it was in 2018, despite slowing growth, the outcome for equities is really good. And I think the action really is going to be in emerging markets because the dollar is going to weaken, and emerging market equities, which had a terrible 2018, will end up being significantly better performing in 2019.
We've already seen a preview. Emerging markets, MSCI, highest in more than 5 weeks.
Yes, indeed. But I think given the drawdown that they had last year, there's still more to come on emerging markets. We are talking about 15-20% type returns as opposed to 2-3-5% type returns.
Noah, how do you position yourself for a slowing economy?
Right, it's a tricky balance, right? You don't want to be over your skis in the cyclicals. At the same time, we've done a lot of work trying to make the argument that being defensive too early actually carries some opportunity costs. So we're going to look for quality companies, strong balance sheets, strong and defensible margins. I think margin is a big theme for us this year. And in a world where EPS growth probably scales more closely to revenue growth than it has in the past, any incremental source of expansion or growth there we think is really, really valuable. So places that have a little bit of operating leverage left, places that don't have too much labor market exposure, to us, that's a real sweet spot in the U.S. market.